The most important thing in trading is not just all about strategy. I believe in trading, most strategies, a lot of the strategies we see, trend lines, support resistance, a lot of them do work. But the most important thing is how you manage your risk. So even if you have the most complicated or most exciting strategy, if you don't know how to manage your risk, you're basically going to be running in a circle. So in today's session, I'll cover mostly about how you manage risk. Now, for you to take a trade using a 1% risk or 0.5% or 0.2 or 0.1, there needs to be something behind it. It's not just because you see the break of structure or you see your fair value gap or low resistance or high resistance liquidity. It's not just all about those things that will make you use a particular risk parameter on that trade. Now, what to look out for is what time frames break of structure did you see the market break, and what are we retesting into? So for example, if we're working with, let's say, for example, the market broke a daily structure. So let's use Euro as an instance. So looking at Euro right here, you can see that the market broke a daily structure right here significantly. So after breaking a daily structure, if I'm looking for a trade idea to buy Euro from this low, I can confidently use between 0.5 to 1% risk. This is a high probability trade setup. Besides the fact that already our 12-month time frame is bullish, we're anticipating for a continuation to the upside. Now we see price break a significant daily structure. I can use a 0.5% as my first entry and another 0.5% as my second entry, or I can even use a 1% risk on my first entry, 0.5% risk on my second entry, or 0.3% risk on my second entry. The reason is because we have broken a significant structural high. So price coming down here for a retest, this is high probability trade for the markets to continue to the upside. If the market breaks, let's say, for example, the market breaks a 4-hour high, and as you can see right here, let's say the market breaks a 4-hour high, we break a 4-hour high, I can confidently look for points of interest, for example, a fair value gap, and I can use something like 0.5% risk, 0.4% risk on that trade. The reason I'm not using 1% risk on this one is because despite the fact that the 4-hour time frame is still a higher time frame, but on the higher time frame perspective, if you're thinking about weekly, monthly, 3 months, the 4-hour time frame is a lower time frame if you're comparing it to those time frames. But the daily time frame is actually at the middle of these other time frames. The daily time frame is actually a higher time frame, even when you're comparing it with the weekly and the monthly. So the market breaking a daily structure signifies momentum to a certain direction. The market can actually rally above a 4-hour high, run the liquidity, and easily still continue lower. That is why I would prefer to use a 0.5% risk if I'm taking a trade off a 4-hour break of structure. That despite the fact that the 4-hour time frame on the lower time frame is a high time frame, it can easily be manipulated on the intraday levels. That is why you reduce your risk if you're trading with a 4-hour time frame break of structure. Now, let's say you're taking another trade and it's using a 1-hour break of structure. If you're using a 1-hour break of structure, you have to reduce your risk even more to 0.3% because 1-hour high can easily be broken and price will go straight to the stop loss. An example is right here. You can see right here, we have a 1-hour high here. And you can see how price rallied impulsively, broke that structure, came back, retest, rallied again, dumped, went straight to your stop loss. Imagine if you were risking 1% on this trade. You would have lost 1% so easily. This is why the lower the time frame, the lower your risk. The higher the time frame, the higher your risk. Does that make sense?
Yeah.
Yes, Mr. Henry.
I have a question, I'm sorry.
Yeah.
So basically, I know we can actually use we can actually use any of the time frames for as our point of interest. But what would you what would you advise? I will say I don't know if there's an ideal time frame, but what time frame would you actually advise we use most times as our point of interest? Like for example, if we've used the 12 months time frame to determine the direction of the market, we come to either the monthly or weekly to look at to check to actually observe or to observe to watch the trade. So like which of them would you advise we use most of the time? Monthly or weekly?
So now if you're looking for a point of interest, for example, if you use a monthly time frame point of interest, you probably might get into maybe 5 or 6 trades in 1 year if you're using the monthly time frame to look for points of interest, because each candle is a monthly candle.
Yeah.
So price could take months to mitigate. For example, look at this fair value gap here. This is a point of interest. Price could take 3 months, 4 months to get into here. So that means, let's say if you're looking for a trade from this fair value gap,
In which
you're going to do nothing
wait for
for the
months.
next 4 months or 3 months. On the other hand, using a weekly time frame is actually a higher time frame, but the disadvantage of using a weekly time frame, a weekly point of interest, is it will also take weeks for price to mitigate that level. And those weeks could be 6 weeks, 7 weeks, 8 weeks, which now totals to 2 months of you doing nothing. So the best time frames to use is usually the daily and the 4 hour to look for a point of interest. The
Yeah.
daily and the 4 hour.
Okay.
Now, the reason I suggest the daily and the 4 hour is because these are key levels that can easily show you intraday points of interest for you to take your trades. An example, looking at the daily, right here, you can see the daily. We have a daily fair value gap here, a daily fair value gap. These are points of interest.
Yeah.
Price, can you see how it took price 1, 2, 3, 4, 5, 5 days, drop in there, gave you a trade, boom, went straight up.
Yeah.
5 days, yes, it's a long time to wait, but if you can just capitalize and wait for 5 days for a high probability trade that you take 1% risk on, even if it delivers a 1:4 and you're trading $100,000 account, that's 4 grand. It can take care of your monthly bills and stuff. And next month you're looking for another good trade, high probability as well. You're
And
not gonna
we could have multiple pairs and that we're watching.
Exactly. And you
No.
also have multiple pairs. You can watch multiple pairs. You can watch NASDAQ or Euro or US or GBP. And let's say each one delivers one trade for you in the week that you take good risk on and you make 2, 3% every week. You're good to go. If you do the math on a 100K account, that's around 7 to 8,000 a month. That is literally the easiest way to fire your boss.
That's my plan. Okay. All right.
So if you can stick to a plan and just say, this is how I want to do it. I want to wait for this higher time frame point of interest, and I want to use specific risk parameters and take those trades. You will realize that you see a level of consistency in your trade. There'll be a level of consistency that will be on your trade. So always focus on the higher time frames. I know it sounds interesting. I see a lot of traders tell people 1 minute time frame is how I'm getting into the trade. But do you know one thing they're not showing you is the dozens of losses that they've taken before they got into that one winning trade that they are showing you. Now, to go back into what I was talking about when it comes to risk management, the lower the time frame, the lower your risk. If you're seeing a break of structure on the 15 minutes time frame, you shouldn't be risking anything more than 0.25 or less. You risk between 0.25 or 0.2, 0.15. Don't risk anything more than that because the 15 minutes time frame can easily be broken and can also easily run the low, your stop loss. Now, if you literally put a 1% risk on that, in minutes, price will literally wipe you out. Now you're back to zero. You're deep in regrets, wondering why did I even make this decision? The same thing goes with 5 minutes. If you're using the 5 minutes time frame break of structure, you shouldn't be risking anything more than 0.2% or less, or 0.1. Because the 5 minutes time frame, price can literally run the high, run the low, run the high, run the low, run the high, run the low. It can literally do it like 3, 4, 5, 6 times. That means if you kept buying it, that's 3, 4, 5, 6 losses in a row. And if you're risking 1%, you're done. 5 losses, 5%, you've blown your account. Your account is done. If you're trading a prop frame, you're out. 5% drawdown, that is it. Game over. The same thing goes with, I personally wouldn't even recommend you guys going lower than 5 minutes right now. I personally would not recommend it. There's no point for you guys going lower than 5 minutes time frame break of structure. Because if you go lower, the lower you go, the lower the risk. Unless you're ready to risk 0.1% or less, then yes, you can use the 2 minutes.
Okay. So you mentioned that for the 4-hour time frame, we should use like 0.5 instead of 1%.
Yes.
Okay.
So if you're working with a 4-hour break of structure, you can confidently use a 0.5 risk, 0.5% risk. An example is this trade right here, broke structure. Price coming down here, you can confidently use 0.5% risk right here, stop loss right here. So if you're trading, for example, you're trading a $100,000 account, this is your stop loss right here. And even if, let's say, for whatever reason, you closed it here, this trade would have delivered almost around 1,800. If you're trading a 100K account, risking 0.5, 1,800 on just this trade. You take that 1,800 and you're good to go for the week. Next week we go again. Price coming down here, you're looking for an opportunity somewhere for a buy. The only thing you're interested in is in a buy. If this trade doesn't work, runs the low, you still start your analysis from fresh again and look for another area to buy it again. If it's a daily break of structure, right here we'll have a daily break of structure. Now you're risking 1%. If you're risking 1%, this would have delivered a $3,800 profit. You take it, you bank it, you get out. Does that make sense?
Yeah.
So you just keep it
Yes, Mr.
simple. You have to keep it simple and you have to also manage your risk accordingly. So I can confidently use a 1% risk on this trade. My stop loss rested below here.